he will explain what is that to you shortly. But you know how important it is to read a balance sheet, right? To be able to know what is happening within the company, because the balance sheet is what tells you about the health of the company, just like our heart will tell us what is happening in our body, right? So, so O'Neill is here, he's getting set up, and he is ready to go to explain to you about this very important phenomenon. So put your hands together for Sir Edward Summit, please. You can explain to me what is CFA.
I think there's more coming on. Or not?
Let me say a good morning to everybody. So, my presentation today, I get all presentations, right? We'll be talking about some basic.
Oh, they mentioned.
Everybody hear me?
Excuse me.
Yes, madam.
Including. You know, my life never ended. Can't trust me, you know, sometimes. Them send all them thing.
Alright, okay, so we'll be looking at some basic ways of dealing with the balance sheet. And as he said, I've completed the CFA course. CFA course is this institution in America that really governs the financial industry worldwide. So if you want to be a financial analyst or a certified financial analyst, because that's what the CFA stands for, you have this course that you have to do with that institution, right? But from my reading of financials, what I've noticed though is that all of financial, any information that you can get in a finance course or concept is really basic. And when I say basic, I mean there's no concept in financial stuff that the average person cannot wrap his mind around, right? Moreover, it was Warren Buffett. Have you heard about Warren Buffett?
Yeah.
Warren Buffett is arguably the greatest investor alive, right? What Warren Buffett actually said is that in finance you do not need more than average IQ to do very well at finance or at buying and selling stocks, right? But then finance is really hard, isn't it? Really hard. But what I've realized is that most people who I call them the big boys in finance, what they really do is communicate finance in financial jargon, right? So they have a language or a code that they call finance, right? And that is the reason that the average person cannot understand finance. So what I do today is to strip away most of those financial codes, right? And talk finance in the layman terms so everybody can really understand what's really happening. All right? All right, so the presentation, the presentation will look to answer 3 questions. First, we'll be looking at what the balance sheet is, and I guess everybody going to have a good idea as to what the balance sheet is, what does the balance sheet represent, and then at the end of the presentation, we'll be using those information that we garner on the balance sheet and try to decide whether or not a company stock is overvalued or undervalued. And that should be interesting. All right, so what's the balance sheet? So this definition, I pulled it down from the CFA Institute site, right? And it means that the balance sheet is a financial statement that provides information company's resources are its assets and its sources of capital, equity, and liabilities and debt. Right? So this information helps an analyst assess a company's ability to pay for its near-term operating needs, meet future debt obligations, and to make distribution to its holders. So if you look at this definition from the CFA Institute, it is coded in financial jargon, right? So it talks about things like equity. What is equity? It talks about, and then the term equity in finance is used in many different ways, right? So now it might mean something else. When you read like something else, the equity means something else, right? So you have to know the difference. Liability. So those are financial codes that you might not be able to understand what the sentence is really saying. All right. So if we should take away that those, yeah, what CFA is really saying is that the balance sheet is this document, right, that tells you about the company's asset. Nothing more to it. So if you want to understand what type of asset the company owns, right, just turn to the balance sheet and there the information is. Okay? All right, so we cannot talk about the balance sheet without talking about two other important financial statements that there are. So we have the income statement and we have the statement of cash flow. Income statement, statement of cash flow, what these two statements do is I normally call them flow measurements. So what they do is to measure the flow of things, right? Activity over a period of time. So the income statement measures the flow of income coming into the business over, let's say, a year's time, right? It also measures the flow of expense going out of the business. Cash flow, statement of cash flow, as the name states, cash is on the cash. So all of the cash that comes into the business, we can look at the cash flow statement to know where the cash is coming from. All of the cash that goes out of the business, the cash flow statement tells you where that cash is going. Right?
Sorry to pause you, but could you go back? Please, just for a second. Now to the last slide.
The last slide.
Yeah. You said that. Yeah, you said it's the assets. Full stop. What understanding or what information or what
you can get from?
No. What understanding do you use to negate liabilities in that definition? Why did you remove
that as a presentation?
Yeah.
So you can just look to see if I answer your question as I proceed with the presentation, right? All right, so as I said, the cash flow, it measures really the cash that comes in and goes out, right? So how do we compare these two statements or contrast them with the balance sheet? So whereas they measure activity, the balance sheet is a static measure, right? So at the end of the period, you want to measure your asset at a particular point in time. And that's what the balance sheet does, right? So if you look at the heading of a balance sheet, you will see as at a particular date, right? So it measures, it's like a picture. As against these, the income statement is a motion, like a moving, things moving, right? But the balance sheet is, right, permanent. All right. What you need to understand though is that asset moves, assets are dynamic. Even though the balance sheet measures it at a particular time, those things change. So if you should do a balance sheet for the same company in, let's say, an hour later, it will be two different balance sheets. Because if you have cash and you pay cash to your employees, then cash would be lower than. You understand, right? So we'll have to deal with that. That's one of the problems with the balance sheet. So if I ask, what does the balance sheet represent? And I should use a medical term, I'd say that the balance sheet really represents the health. It's a way of measuring the health of the business. So whereas if you're a manager of a business and you diagnose that the business has some problem, right? Then the manager would set to work trying to solve that problem. So within the year's time, all the activities that the manager is doing, the income statement and the cash flow will capture those activities throughout the year. Then at the end of the year, you want to test whether or not the business is getting better or getting worse. So you want to use that balance sheet to decide if the business is improving. All right. So now that we know that the balance sheet is this way of testing the health of a business, let me ask you a simple quiz, right? What if we have two companies? Let's say it's company A and company B. And company A has a balance sheet of, let's keep it very simple, $100. And then company B has a balance sheet of $200. Would it be fair for me to say company A is a better company than company B? Because it's smaller than company B, it's more flexible than company B? No. Alright, company B must be a better company then, because it has a larger balance sheet, more assets. No, not necessarily. Why not necessarily?
Budget might be higher.
It's a point in time and things keep moving. Alright? Then what if I'm testing the comparing them at that particular point in time? Would you say at that point in time one is better than the other? You can say that. Some people say yes you can, some people say no you can't. Alright, to be honest, it is really hard to tell if a company is better than another simply by looking at its total asset. Right? The total asset does not give you enough information for you to say that. So guess what? People who put the balance sheet together, who are accountants, they know this and they are all friends. Right? So what the accountants try to do is to dissect the asset into different parts to communicate information to you as the investor. Right? If you have a balance sheet, right, you can look at it. The assets are structured in different parts. This is a sample balance sheet. So if you look at it, the assets are really structured in different parts. It makes for a good presentation for one, but that's not really what the accountant is doing. What the accountant is really doing is to tell you something of importance about the business, right? So it's not just a structure of it. A lot of information you can gain from how it is structured. All right, so the balance sheets are structured, or an accountant separate the balance, divide the asset in two ways, right? It uses time to divide the asset, and then it uses the mean of financing the asset to divide the asset, right? That's how you cut the balance sheet. When we talk about the mean of financing the asset, you're really answering the question, where did the manager get the money from to buy those assets, right? And we'll look at that as we deal with the liability. So if you look at the top half of the balance sheet, above total asset in the middle of the page, that top half of the balance sheet is divided, the total asset is divided by time. So you have two groups of, assets, right? You have current asset, which is here, and you also have non-current asset or long-term asset. Current asset means short-term asset, right? So the short-term asset that we have are cash, account receivables. You know what account receivables are. If the company sells product on credit, and people owe the company money, that's what they call receivables. So it's really money that people owe the company. And we have inventory, prepaid rent. All right, so for every business, there is what I call a normal level of current asset that the business is supposed to own at any time. Anybody that has ever run a business would know that, right? So then, you might want to have a certain amount of cash on hand, right? so as to pay your bills when your bills come due. Because if you do not have that cash, then you might run up in problems. Inventory is the same thing. You might want to have a certain amount of inventory so as to meet the demand as they come due. Right? So then, you need that amount of asset that you should keep on, current asset that you should keep on your balance sheet at any time. We would call it your normal asset, the normal current asset for operating. And we are saying that if you keep less than what the company really needs to operate, you might run up in some problems. Also, if you keep too much asset, too much current asset on your balance sheet, that can end up into problem also, right? So you want to keep that normal amount. What if you have too much asset on your balance sheet? What does that say about, let's say, your management? If the management keep too much asset, right? So it's like the management is wasting the company's resources. Because if you have too much cash, you could use that cash, put it in a bank and make some interest on it. If you have too much inventory, it's the same thing. If you're a car company, or for instance, you're a restaurant, and you cook too much food, what will happen to the food if it doesn't sell? It's spoiled. The food spoils, you lose money, right? So you want to keep that normal level of asset. And it's really a judgment card, right? So nobody knows what this normal level is supposed to be. All right? Okay. All right, let me just skip to here and show you just, this is an extract from Dermont Trading. This is actually a company that trades on the Jamaica Stock Exchange. And this, what I'm going to show is how you could have read into the balance sheet to know what the company is about to do. So maybe you could purchase the company before the company does what the company was planning on doing. All right, so if you notice, you have the cash in bank, right? And here, in 2015, we have 39 million cash in bank.
Yeah.
Then in 2016, the company increased that cash in bank to $157 million. That's a 99% increase in cash. The company did the same thing in 2017 to 2018. It increased cash by almost 70%, right? So we said that there's a normal amount of cash that this company, what this company does, it owns a chain of supermarket. So it's a retailer that buys and sells goods, right? But what we are noticing is that the cash is increasing very fast. So if the cash is increasing faster than the company is growing, right, it must have been that the company is keeping excess cash on the books. Again, it's current account. The cash is current account, current asset. So that means that the company is planning on spending that money in the short term. Within a year's time, all that cash must be spent. Okay? And if the cash is not spent, then it could mean that the manager is not managing the company properly. So let us assume then that the manager knows what he's doing and he's managing the company properly. So if you see cash increasing like this, it is telling us something other than is the manager want to do something than the normal thing, right? So what could the manager want to do? Look at it. Exactly. So in 2016, the manager increased the cash because in 2017, 3 months after that was March, look what the manager did with the money. He was planning on using that cash, right? So 2017, they bought 2 more supermarkets. So you can imagine what happened to Dermont Trade stock on that set day when the Observer article came out. That it is buying more, the company is actually expanding. The same thing happened in 2018. The manager increased the cash by 70%. Just the other day, September 13, 2019, that's 9 months after, but it's still within the 12-month period. The cash, they actually purchased a new warehouse. right? So to the savvy investor, if you were simple just looking at this, you could have purchased the stock before this happened and maybe make a kill on the money, right? All right, so let's go back to the long-term asset. Non-current asset is here. All right, so on the long-term asset, I'm not having one of those that you're looking at. Long-term assets are assets that the company will not use up within the year's time. So it will take more than 1 year for the company to use those assets. All right, so if you look at your assets, you see like land, building, and those types of things. Currently, what accountants do is to group all of those assets and call them PP&E, property, plant, and equipment. Right? Now, again, the accountant is trying to say something to you. What is he saying? You can look at the property, plant, and equipment on a balance sheet and tell the type of business that it is. For instance, think of a BPO. The BPO sector is now booming. Do you think the BPO will have a lot of property, plant, and equipment on the balance sheet? No, because the BPO only needs a space and a couple of chairs, right? It doesn't need a property, plant, and equipment. So service companies do not have a lot of property, plant, and equipment. So if you're seeing a company with a lot of property, plant, and equipment, it must be a manufacturing company or those type of companies that use heavy units, right? Now, with the heavy unit comes what we call depreciation. What is depreciation? It's the wear and tear of the property, of the equipment that you're using. And guess what? The company has to maintain the equipment in order to keep them productive, right? The maintenance is a cost to the company. So let us say then that you have a company that has a lot of property, plant, and equipment, maintenance is high, and then you're expecting inflation to increase. What will that do to the company's expense? It will increase the company's expense. So companies that have a lot of property, plant, and equipment, they are prone to inflation, right? Worse if they cannot increase their price accordingly. So here you have your cost is increasing, the revenue not moving. What will happen? The profit margin will get squeezed. All right. Another thing with companies that have a lot of property, plant, and equipment, non-current assets, is that they have the capacity to use more debt than companies that don't. So the banks are more willing to lend to these companies. You know why? Because the property, plant, and equipment can be used as collateral, right? So that's one of the good things about those types of companies. Yeah, we'll look at that in a few. All right, so the other half of the balance sheet, if you're following, the accountant, what the accountant does is to divide the asset into what we call the way in which the manager raised the money to buy the asset. All right, so there are two ways that the manager can raise money to buy an asset. Either the manager uses his own money or the manager uses other people's money. There's no other way. So they have this thing that I call preference share. And I hear them talking about what? Cloud financing. Anybody know that? Because I really don't know what it really is. But at the end of the day, whatever they call it, it's either equity, which is the manager's own money, or it's liability, which is somebody else's money. Right? So let us look at equity. If you're following on the sample balance sheet that you have, you see that equity at the bottom of the balance sheet. That's what we say is manager's money. So where does manager get the money to use, right? You see what we have, paid in capital, and we have reserve earning. Retained earning, right? The paid in capital is the money that the manager used originally to start the business. The business is running and the manager decides to add more of his money to it. It's what that's paid in capital. It's what you call fresh cash. Okay? Retained earning now, that's money coming from the business itself. Right? So if the business is profitable, then and the manager decides to use that profit and put back into the business, it comes onto the balance sheet as retained earning, right? So retained earning is telling you something about the profitability of the company. So if you see retained earning growing over time, it means the company is growing and the manager is plowing back the money into the company, right? So that's that. All right, so now we are at current current liability. So again, this is other people's money now that the manager has. So what the accountant does is to split liability into two parts, right? So it does it by time, just like it did total asset. So what you have is current liability and non-current liability. Current meaning all these liabilities, all these debts will be due within a year's time. So the reason why the accountant split out the liability like that is to tell you that, look, all these things will be due within a year, so the company must make preparation to pay to ensure that it has enough cash, enough current asset to cover these bills, right? And I will show you a way how analysts really calculate whether or not the company has enough cash to cover current liability. All right? What are the different types of current liability have? Let me see. You have account payable. Anybody know what account payable is?
The obligation you owe to people within a short period.
It is money that you owe to the suppliers, right? You have what? Tax payable. That is government. You know, anything that has to do with government is interest payable. All right? So that's short-term interest. Interest that you have to pay within a year. All right, so let's move on to long-term liability, or what we call non-current liability. Non-current liability is really a long-term debt. That's a major non-current liability. All right, so the money that the bank lend you, it will come onto your balance sheet as non-current liability or long-term liability. Now, as analysts, we do not like to see a lot or any. We like company that has no debt, right? You know why? When you put debt onto your balance sheet, you're really taking on risk. What is the risk that you're taking on? The creditors, or should I say, it is only companies that have debt that really can go into bankruptcy. So if the company has no, you never hear a company that has no debt go into bankruptcy, but because it's one of the creditors that forces company into bankruptcy, right? And bankruptcy means pre-ending of the business, ending the business before time. All right. So we like companies that do not really have a lot of debt. But as I said before, companies that have lots of PP&E, it has capacity to take on debt. All right. All right, so this is the Wigton Wind Farm common size balance sheet. So we look at Wigton in a few. But what we said though is that the balance sheet is this static measurement, but the assets on the balance sheet are dynamic and they change over time. So in order to capture that change by just looking at the balance sheet, what we propose is that you, instead of looking at a single balance sheet, you combine the balance sheet and look at them simultaneously. All right? So then you can see the chart, the trend that an asset is taking. All right, so this technique that we use to look at three of Wigton's balance sheet is what we call the common size balance sheet. What is a common size balance sheet? So all the line items on a balance sheet. So you have your PP&E, you have your current asset, your inventory. We divide all of those by total asset. So like I say, cash divided by total asset. Inventory divided by total asset. Right? And we do it for different years. So then you can look at the trend right? And you can see what portion of total assets each of those line items represent. So let's just look at the Wicton. Who here bought the Wicton share? You must have made a kill on it, right? Did you look at the balance sheet before buying? Or you just move with the eye? You look at the balance sheet, you did the analysis.
Absolutely not. But we know them more a lot of money.
I bet you never look at a common size balance sheet though. Okay, so let us look at the common size balance sheet and see what we can garner from this, right? First and foremost, if you look at PP&E, you see what percentage of total assets is PP&E. It's almost the entire thing. It's 80%, 83%.
Property plant and equipment.
Property plant and equipment, yeah? So you know the operation of Wicton. That Wicton has some big
Wind turbine.
Exactly. Those are very expensive. So that's the reason why you see property plant and equipment is that high. But what did we say about companies that have a lot of property plant and equipment? Depreciation. Remember? So they have to maintain those property plant and equipment. Right? Also, those companies tend to have a lot of debt too, right? Because they can afford to borrow. Banks are willing to lend them. So let's just look at the debt. Look at the yellow line at the bottom. Long-term debt. What percentage of assets is long-term debt?
Over 50%.
That's a lot of debt, right? So Wicton has a lot of debt. You know where Wicton get the debt from though? No?
Government and Jamaica refinancing from the bank.
Where does Wicton get so much debt on the balance sheet? Because here,
refinancing from
debt is 61% of assets. So how Wicton started is the government that started Wicton. So the government did not use its own money to start Wicton. What the government did was to borrow money from the bank. And they were willing to lend it because they're going to buy a lot of property, plant and equipment. If anything happens, we can sell those and leave the money. That's another thing again, because the government backing is there, they even get the interest rate at a lower rate. Alright? So imagine now that the government is out. What are you going to do with the debt? And at what percentage are you going to get those debt? Those are some of the issues that we will have going forward. Alright? But, as I said before, this company can take on a lot of debt. And as you can see, Wicton is really taking on debt. But, look at the trend in debt. Is it moving in the right direction?
Yes,
it is trending down. And that is what you want to see. So that's a positive for Wicton, right? Alright, so let's go back up to current asset. Look at inventory. Wicton has no inventory. If you understand Wicton operation, you know why it doesn't have an inventory.
It doesn't store electricity
and sell it
to the grid.
JBS. So it has no room of storing or no means to store the generation of energy, right? Receivables.
For real.
Very small amount. Wicton sell cash. Right? Which is good, right? And it's also trending
Down.
Trending down.
It's
So
very
if
bad.
Wicton sell its product by cash then, it must have a lot of cash on its balance sheet.
Yeah.
Must have a lot of cash to spend. So let us look at cash. Is that a lot of cash to you?
No.
Wicton cash is just 11%.
7.
14% it trends up over the year. It's not a lot of cash. Exactly. So what is Wicton doing with the money?
Pay back loan.
What are they doing? Pay back debt. And they are also maintaining the
Equipment.
exactly. So that's where Wicton money is going. They're paying debt and they're maintaining. It's high maintenance business that they're in. So currently inflation is down worldwide, so that's good for Wicton also. So in the event that inflation increases, the cost of maintaining those assets will also increase. And that could be a negative, right?
What's current portion of long-term? Where is it here?
Current portion of long-term, or current portion of long-term debt. Oh, we talked about that. The current, that here. All right, so you have, the company can borrow debt long-term or short-term. right? And the company, the long-term debt too, you have interest that you pay on the debt. So when the interest is due within the 12-month period, it becomes current because 12 months is what we talk about short term. So anything that is within a 12-month period is short term, right? So it is the interest that you need to pay on your long-term debt in the 12-month period. So if interest is due next month, it comes onto the balance sheet as short-term debt. All right? Good question. Why is current? Why it is trending down? It is trending down because Wicton is also trending down as long-term debt.
Yeah.
All right?
So I'm saying that all better have stay for a long time without the extent payments on it.
Sorry?
So what you're saying is that all the debt is still on the books, you don't expect to have to make a payment on it in the next month.
Yeah, whatever you have to pay within that 12 months, it is now short-term and not long-term.
So they have paid off all the short-term debt.
That's what they are doing. So debt, so when you say the debt is trending down, that's where they are cutting debt from. All of those short-term debt, if they borrow debt short-term, that's where it's coming down from.
The short term, they be more expensive to get rid of it.
Sorry?
Short term, they be more expensive, like a BO,
Exactly.
and then you get rid of
So it
it.
might be more expensive than the long-term debt, so they decide to pay off by the short-term debt. The smaller debt than the longer debt. Okay. Right. So that is trending in the right direction. And debt for Wicton is the real issue. And if you look at the income statement, right, because the interest at the payment will come as expense on the income statement, so you can look at the income statement to decide if the interest is too high, if it's taking away too much of your money, right? The other year, Wicton refinanced the debt. I don't know if you remember that. So the debt was in US dollar and then changed it to Jamaican dollar. I know why they do that, right? Because when the dollar slides, they usually have to pay more Jamaican dollar to. Yeah. So that's another good move there by Wicton. So the other year, Wicton released its profit, and the profit was huge because of the saving that they make on the Jamaican dollar. All right. Look at equity. Equity is trending up, and this is what we want to see: less debt and more equity in the business. That means the creditors will not come and possess the business, right? Take back the business from the investors and sell it to recoup. Whatever. So Wicton is on a good trend, would you say?
Yes.
All right. So where's equity? The increase that we're seeing in equity, where is that coming from? Is it fresh cash coming into the business, or is it the business? Profitability, yeah. So you look at your retained earning. This year is the cash that they start out with, 2%. It doesn't move. So the retained earning is increasing. So the owners of Wicton, which are the shareholders, right? You are plowing back the money. Instead of paying it as dividends that you can put in your pocket, you're putting it back in your company. Okay? All right, so let us move on. All right, so liquidity ratios. When you talk about the liquidity of a business, what there, and you can follow through on what it's the formula sheet. There's a 30 formula sheet to see where we're calculating this. All right, so when you talk about the liquidity of a company, what you're really asking, or what you're really trying to solve is whether or not the company has sufficient short-term assets to cover its short-term liabilities. Short-term assets to cover the liabilities that will be due in 12 months' time. Right? And we know the problem that comes with that. If you're not able to pay your bill, the JPS bill, the water, the phone bill, what will happen? Right? And it's even a cost to the business. Because what suppliers do is that they give you a schedule. The earlier you pay, and JPS start doing that, the earlier you pay, you get a discount, right? So So you want to pay on time so as to get that discount. Alright, so short term we have three current liquidity ratios. We have the current ratio, the quick ratio, and the cash ratio. So what is the current ratio? As we said, it is your current asset divided by your current liability. So if your current asset divided by your current liability is 1, that means you have just sufficient asset to cover your liability. So you don't want that to be more than 1, right? Meaning you have more current liability, current asset than the liability that with the falling yield. All right. The quick ratio now. What they're saying is that some of your current assets are not really. They are current assets that the company wants to use, but they are not close to cashing up. They are not readily available. So like your inventory, you'll have to sell the inventory before you get cash from it, right? And that might take a time. You might not even sell it. What we see there, the prepaid rent, so if you pay your landlord, can you go back to the landlord and say, look, give me back the money I want to pay? No. So what we're going to do then is to take those assets out of the current asset. And we're just looking at the ones that are most liquid, that are readily available. Right? So it is your cash minus your inventory, because we don't know if the inventory will be sold when we really want it, minus the rent that you already paid, because the landlord now give us the money, divided by your current liability. Right? And again, when that ratio is 1, it means that what you have is just sufficient to pay your liability. So you don't want that ratio to be greater than 1.
But you may have to discount accounts receivable at times, so you can't really use accounts receivable. You may have to put a discount, because if people don't want to pay you on time,
you have to discount to get the money.
Yeah.
So you're saying account receivable should be taken away from.
You should have, yeah.
All right. So look at this now. The cash ratio. The cash ratio just deal with cash. So it takes away the account receivable from it. It takes away the inventory and all of the other ones that are not really cash, right? So you can look at it. All right. So this is actually a company that is trading on the Jamaica Stock Exchange. It is PBS Productive Business Solution. So what I did was to do the ratio for it. So look at the current ratio. What you see happening? It is trending up, right? It's greater than 1, which is good, and it is also trending up. So in 2018, the company has twice as much that it really wants to use to pay the bill, which is good, right? The quick ratio, when we take out the inventory and we take out the rent, it is above 1, it's good, fell below 1, but it's trending up, right? So it is 30% above what you really want. But let's look at the cash. The cash was 40% of your current liability. And what's happening to cash?
Decreasing.
And now cash is what? Just 11%. Is that enough? What if 15% of your liability falls due today? You will not be able to pay those. So
But
even
I'm
though
going
you're
to
able
stock
to cover
exchange.
with all of the current asset that you have, it's not enough cash. And I guess that's what you were saying.
Would that mean that liability have increased?
The liability have increased.
Would have increased.
You have to look at the movements in the liability to decide
Yeah,
what's
that
happening.
might be a reason, that it might have increased, and so that's why the cash.
So it could be the liability that has increased, and it could be that the cash is you're using up the cash, right? So it's both. So you have to do the research to find out what's really happening, right?
What is the ideal for the cash ratio? What is the ideal ratio?
Over 1. Anything over 1.
No, cash. No, I think so.
Alright, so you're
1?
asking the same question. What's the ideal?
1.
In finance, there's no ideal. And that's the good thing about finance.
It can be 1.
So how I like to look at finance is that finance is
so.
a science
Cash ratio.
and it's also an art.
Cash ratio,
Right? So what's the science about finance?
money, right?
The calculation of these ratios.
The company.
If you calculate the ratio right, everybody will get the same answer.
Right.
And if you get the wrong answer, you're not doing something right. Right? That's science. But then the art comes in. How much current ratio do you want? I don't know. How much is good for the business? I don't know.
But you know you want over 1.
But you know, it must be over 1.
So is there anything like that? The cash ratio is important.
The trend is important. So what I'm saying now is a judgment call. Even the manager that owns the business has to judge whether or not he should keep more than or less.
That's the more.
Right? So it's really a judgment call.
Okay, cash ratio. And which one?
No, I don't know.
And as I keep studying and like studying the industry,
Cash ratio.
I can look at the industry, what the other companies in the industry are doing, how much they are holding, it might tell us something.
Yes, sir.
Them have a whole heap of left to digital Steven. Them in some problem and them more or less.
Yeah.
But them more or less manages. Because the IPO got shot and people have lots of boom. And they just cash out early and then boom.
Decreasing. Should I be worried or should I look into other things as to where they are spending their cash, such as their money trading, actually investing in new supermarkets? Should I be worried if I see a downward trend in cash rate?
So what they should do, call the manager, do the research, find out what's really happening in the business. So if the business is expanding and using up cash, if I were you, I wouldn't worry, right? But if the business, let's say the business is wasting the cash then, using the cash doing something that is not really expanding the business, right? Then maybe that's reason for worry. But it's always good for you to call up the manager man and ask him, you're now a shareholder, so it means that they should talk to you, right? And tell you what's really happening if you should have a question.
That's why I have general meetings.
Yes. Then you might be worried.
Maybe it's saving for a big purchase. Maybe it's saving
So you can,
Maybe buy a yacht.
yeah, you can look at the cash flow.
When you hear board member meeting and those stuff, because still I'm open to trade
Yeah, the information has to come out and look at the cash flow to see where, and I say cash flow tell you where the cash is really going, so you can decide.
I'm saying that that isn't good because sometimes when you retain too much cash, you will lose some profit that you have made. So when there's too much, based on your demand, you need to invest that cash so that you can make returns on it.
Exactly.
So that trend is good based on demand of the company.
Exactly. So this trend, you're saying this trend is good because they're saying maybe this is the normal amount of cash that the company should hold, right? And the company is investing the other amount of cash, the excess cash. All right. So that's one argument. Other people might say, look, we want the company to have a steady cash instead of cash decreasing, right? Because then the company might not have enough cash to pay the bills. And if you do not have enough cash to pay the bills, then that's bad for the company. So again, this is what I'm saying. Finance is really an art. And that is why some people buy stocks while others are selling. Because you might have an idea that it's good trend, it's a good trend, and buy the stock, and other people say, no, it's a bad trend, and sell out. But it's the same stock, right? So you have to do your research and make sure what you're doing is right. So what I like about finance, you have your story, put your money where your mouth there, right?
What if there's a major change in shareholder, like a major institution bought the company? You don't have to worry.
If a major shareholder bought into the
Yeah,
company,
the bigger like an institution bought into the company, you don't have to worry about the company if it's something because it has to be a reason for that shareholder, that institution to put their money in the company.
Not necessarily good.
So you're doing, what you're doing, his strategy of investing is what you call coattailing. So you watch where the big investors are putting their money and you just follow them. So like you have a QWI, right? QWI is now a public company. So what they do is to invest in other companies on the stock exchange. So being as it's a public company, they'll have to give out that information as to which company they are invested in.
No,
so this is the strategy. Even though I'm not recommending for anybody, you can watch what they are doing and coattail them.
There's nothing
Right?
offer.
So you see buying more access finance, you buy more access
To
finance.
me, or the general
You
public,
see
it's a
selling
manage
off
other
access
company
finance,
financial.
you sell off access
Nothing
finance, right?
special about that. Some say,
Some people
no,
do that. I would recommend it though. I would recommend it.
Yeah, but I buy it at $69. I have no idea.
They are selling off a company because they don't like the company. Exactly. It might be a better investment.
But you have
Alright, so let's
different
just
ways
talk
of
about the
execute buying.
solvency ratios,
You
right?
can buy it,
And when we talk about solvency,
I don't remember
it's
it's called.
really,
But you have
no, we
to
come back to the
set the limit.
creditors.
One time
And
go
these
through
are the
broker
creditors that are
and then buy
serious.
one stock
They are willing to
for
take away the
$13 per
business
share.
and
And
sell it
it
off
never trade above
and recoup
$4.
their losses,
So
right?
it show you some
So you
ridiculous
want to
shit.
test whether or not the business is solvent.
I remember which one. I think it
Solvent,
was
whether or
Honey
not the
Bun, one of them
business, the
cover
creditors
company.
would be comfortable with the level of
Stop
debt
loss.
that the business has.
Do not spend no
Right?
more than.
And there's not a likelihood of the company going into bankruptcy. So if you follow on the formula sheet, there are three ratios that we use, right? The financial leverage ratio, the total debt to total asset ratio, and the total debt to total equity ratio. Now what I'll say is that all these ratios tell the same story. Right? So what you can do, instead of looking at all of them, you could just look at the middle one, the total debt to total asset. And that can tell you the story that the others are saying. So what's happening? It is your total debt divided by your total asset. It tells what portion of your total asset is debt. And as I said before, you want to keep that low. We do not like debt, right?
Alright.
But look at this company. What's happening with its debt?
It's fluctuating.
It's increasing over time. So it moves from 33% of total asset to
36%.
45% of total asset. Alright? I do not like that trend. I rather the debt trend down. Right? Or still. But then you cannot just look at the balance sheet in absolute terms. You have to look at whether or not the company is comfortable paying the interest on the debt. Because if the bank is collecting interest on the debt comfortably, it's fine with the debt, right?
And they might be using that debt to actually enhance the business to generate more income.
That could be it, too. But I do not like companies that use a lot of debt.
Yeah,
I
yeah,
like
yeah,
companies
dividend.
that use its own
Cash.
money.
Can't get a good dividend.
Right? Yeah, and if the business is profitable, if the business is turning money, you use that money that the business is turning and sometimes grow the business, you know? Alright, so these ratios are called the activity ratios.
Not really.
So what the activity ratios really represent is the day-to-day activity of the
Volume.
business.
Volume.
So if the business buy and sell product, you want to know how fast the business is buying and selling, right? The receivable, people hold the business, you want to know how fast the business is collecting its money, right? And the payable turnover also
One
tells
Jamaica?
you how fast
Which
you
one?
are paying your suppliers and paying your bills.
But
Do you like a
the volume
company
myself.
that
Nobody
carries
knows.
just-in-time inventory?
Just-in-time inventory.
Yeah.
Let's talk about this and then you can decide whether or not just-in-time inventory will be the best inventory management for a company. All right, so let us look at the inventory turnover ratios, right? And as I said, it measures how fast you're buying and selling your products, right? So if that's what it measures, what would you want? A high turnover ratio or a low turnover ratio? You want a high turnover ratio. All right, so how do we calculate the inventory turnover? It is your total revenue divided by what you have there, average inventory. There's a reason why we use the average inventory. I don't know if you really want to get into that, right? But let us say it's your turnover is your revenue divided by your inventory. Remember we talk about the normal amount of inventory that you should hold on your balance sheet or in the business. This ratio assumes that at the end of the period, whatever inventory is on the balance sheet, that is a normal amount. No excess inventory is there. Right? So here, we want to test how fast are you selling off that amount of inventory and replenishing the stock. Alright? The receivable turnover. People owe you money. How fast do you collect that money from those and then trust the goods again. Same thing, you want to do this as fast as possible, so you're looking for a higher ratio, a higher result. Your payable turnover, what do you want this one, high or low? It's how fast you're paying your bills. You want it low, you want it high, you want to pay your bills as fast as possible, right? You're a good businesswoman. Some people want it low though. You want to take as long as possible to pay your GPS bill, right? But the thing is, no, if this is low, it could be good and it can be bad. So you have to definitely know the business and know the type of bills that you have to pay. Exactly.
Can you give an example of good and bad? If it take long, give an example of.
Oh, that will affect.
Good or bad turnover.
Give an example of why it would be good to pay late or.
Exactly like we talked before. For instance, some company give you what they call a schedule.
Because
That if you pay on time, you get a discount. If you do not pay on time, then you have to pay a premium. So even though that's good, you want to see trending down, it could cost the business, right? I guess we'll have to leave it there. I'm sorry.
Yeah, he has to go next door to make his presentation.
So
thank you very much. Can you put your hands together for us? Urban Hall is coming to you right now with IPO opportunities in IPO. Yeah, so you really have to go next door. So, sir, all can you come this way?
Yes, sir.